can you become a millionaire by investing your monthly subscription like Netflix, Amazon Prime, Disney Plus, or even Spotify? Let's find out. First, let's define what a subscription business model is. A subscription business model is a recurring revenue model in which customers pay a weekly, monthly, or yearly fee in exchange for your products or service. Customers can renew or cancel their memberships at any time, but usually these type of business model have low churn rate if nothing negative happens to the business. Subscription services usually goes as a win-win situation for the customer, as they can get the full product or service for a low price, and for the business, since this will be a recurring revenue that flows in for a certain period. WeThrift made a small survey to 1,000 people just to see what type of subscription they have and how much they were spending per month. Let's start with the types. We have video streaming, music, food, miscellaneous, beauty, and wellness. Safe to say that most of the surveyed people have a streaming service with a score of 96%, and the least popular was beauty and wellness. Moving forward to the most popular subscription by generation, it goes from baby boomers to Gen Z. We can see some familiar names like Hulu, Spotify, Amazon Prime, among others. Now, going to the spending, we can see the data and trends of where each generation is spending their money. We have the average overall and then the average per generation. We can see that a lot of people spend money on food. The overall average of food quadruples other averages. And by looking at the red column, the younger the generation, the more they're likely to spend on food. The other categories seems accurate to the standard of what someone would pay on a subscription service. Looking at the total average, we can also see the trend that as time passes, younger generations will likely spend more. Now, what happens if they invest that money instead? For example purposes, we will use Gen X, Millennials, and Gen Z. We will not use baby boomers because they are very close to retirement, so they will not be able to take advantage of the compounding effect over time. Also, the assumptions will be starting with $0 at the youngest age of the generation, and the money will be invested onto a retirement age, which is 65. For the Gen Z assumption, we will use age 18 because that is the youngest that you can open a retirement account. The money will be invested into a fund that tracks the S&P 500. The average return is 10.5% since inception, but we will use 8% instead just to deduct the average inflation. So let's start with Gen X, 42 years old, 23 years until retirement, and investing $221 per month. This will bring us to almost $61,000 invested. That compounds into $168,404. Let's go to the next one, Millennials. Starting at age 26 with 39 years until retirement and investing $214 per month. This will bring us to $100,000 invested. That compounds into $639,877. And last but not least, Gen Z. Starting at age 18 with 47 years until retirement and investing $377 per month, this brings us to $212,628 invested, and the final value is $2.1 million. When we look at the 3X scenarios, we can take some valuable lessons from them. The first lesson is time. The more time you have, the more your money will compound over time. When you see the contributions from Gen Z and Gen X, the difference is roughly $150. But the total return has a huge margin between both generations. This is thanks to the time invested. The second lesson will be contributions. Millennials invested less than Gen X but ended with a bigger total return. This is also related to time invested, but what I want to point out is that the less time you have to be invested, the more you should contribute to catch up. This is crucial for a big return if you're late to investing. Third and last lesson is that the best time to invest was yesterday. The second best time is today. So start investing now. Regardless of their years invested, all three generations were able to get a return on capital. I invite you to log into your bank app and check all your spending habits and where you can cut expenses on unnecessary things. Add them all together and you will see that you really have money to invest. After you get your number, you can head out to my description. I will leave you a link to the investing calculator so you can play around. Input the starting amount, years that you want to invest, and the return per year. You will be surprised by how much your money will grow. Okay, moving forward to my weekly portfolio update. Value is sitting at $5,876.38 with a dividend yield of 3.03%, which translates to $178.31 in annual dividends. This week, I kept buying Starbucks every single day, making it my third largest holding. The stock keeps trading down due to the buyback cancellation and new price targets. I still see it as a buy, like I mentioned in my previous videos. The money from the buyback is being invested back into the stores and employees. If the stores and sales beat expectations long term, the company keeps making money and continues growing. Eventually, the stock price will follow the fundamentals. So right now, I am okay buying more of Starbucks and wouldn't mind if it turns into my biggest holding for the upcoming months. So that will be it for today's episode. Hit like, subscribe, and I'll see you on the next one.